Good day, I am Dr. Suresh Rama, Head of Rates and FX Strategy at RHB Group. Today our topic is on the strength of the dollar. Global Currency Volatility Index has risen significantly, quoted at 10.61% currently, compared to 6% in early January 2022. The DXY index has also risen in tandem, making hedge costs an expensive affair for market players. We believe this elevated volatility in FX markets will remain as the US Federal Reserve delivers another 75 basis point hike in interest rates this month and keeps the door open for further tightening of monetary policy. We foresee Fed fund target rate at 3.5% at the end of 2022 and 4% in 2023, with a balance of risk skewed towards 4% being tested sooner rather than later. On the rates front, we note the yield curve inversion remains in the US Treasury complex as front-end US 2-year continues to edge higher than the back-end US 10-year as the market keeps intact the bias of US Federal Reserve tightening in coming months. Yield spreads are inverted by 16 basis points compared to 84 basis points at the beginning of the year. We continue to recommend to play the US curve inversion theme, with the spread likely to invert further towards 50 to 60 basis points. Hedge costs for euro dollar and dollar yen has continued to edge higher in recent weeks given euro dollar has breached below parity and dollar yen taking out 140. We note implied volatility in the 1 month space for euro dollar is fetching around 11.41%, while for dollar yen at 14.48%. The inversion in implied volatility spread is pronounced for dollar yen, whereby it sits at 267 basis points while euro dollar at 132 basis points. We believe any option structures that are short dated 1 month and below likely to be expensive as markets move away from putting in hedges against the decline of euro and yen against the dollar in the near term as FX spot continues to be volatile. That said, the short-term directional move in euro dollar and dollar yen is likely to limit flow orders, keeping up with the whipsaw moves in both pairs. We note positioning for both currencies based on Commodity Futures Trading Commission data for the week ending 2nd September shows speculators are long dollar against euro to the tune of 5.97 billion and against the yen at 3.74 billion from 5.5 and 3.55 billion respectively in the previous week. Long dollar positioning against the yen has been relatively stable thus far for the 2022 period but has been gradually rising against the euro. The pickup in pace on long dollar against euro occurred at the end of June period, given the aggressive tightening of monetary policy by the US Federal Reserve. Given the stretched conditions in global FX market, we note dollar ringgit and dollar CNH continues to be under pressure. Our inclination is that the ringgit could test levels closer towards 452 and dollar CNH testing levels near 7. Much of the weakness in both pairs are due to dollar strength and the impact of the rest of the Asian currencies under pressure from the US Fed tightening policy. Thank you for listening to this podcast and wishing you the best on your investment plans.